one of the, I would say, the best manner in which a company can secure funds from the market. It has been a hot topic as far as CFOs are concerned, the entrepreneurs are concerned. But as we say, like their IPO is not a, I would say, a buzz of the talk these days. It has been passed also with a different nomenclature. Earlier it used to be called as a, I would say, a public issue. With the passage of time, new regulations have been made by the government to create more, I would say, autonomy to the raising companies. At the same time, more controls have also been exercised, keeping you the, I would say, the IPOs that were issued in the year 1992 and the share market scandal that happened. So, on a, I would say, regular basis, the authorities, they have been revising the guidelines. Also, at the same time, they are giving more autonomy to the companies in terms of deciding the pricing also and in terms of the procedural aspect also. So these days, if someone plans to go for IPO, I would not say it is a dream which cannot be fulfilled. It is a dream which can be fulfilled if there is a strategy in place, if there is a planning in place, and I would rather say it takes 18 to 24 months for a company to well plan for a successful IPO. And it's not a benchmark or a thumb rule that 18 to 24 months is required. It depends on how the company is operating in the past and what has been the mechanism of controls, the presentations in the company, the financials of the company, whether it's a new company or it's already a public company. So it all depends on the factors. But to start with the process, the main thing is that before one goes for appointment of a merchant banker, which is the first step. First step in the sense, a non-formal, because first step is a board meeting where the board of directors decides that we need to go for IPO. The role of a merchant banker is very critical because it is that agency on which you are shouldering the success of your IPO. So deciding the merchant banker is one of the critical elements, and you need, while before tapping a capital market, one has to be very choosy in terms of selecting a merchant banker, because merchant banker at the same time, while they are putting the IPO in the market, they will be directing, guiding the company the way to prepare, be ready for the IPO. So these are the various options: self-funding, crowdfunding, angel, venture capital, business incubators, bank loans. These all are the funding options, but all of these funding options, the best one is a public issue. Then there are other options of funding. So IPO remains to be the favorite topic and the favorite way of funding. In domestic market, there is a term used interchangeably called as IPO or FPO. When it is a fresh issue, it's called as IPO. When there is a offer for sale, it goes for FPO or OFS, as we normally say. And then there is a content of right issues. If the company is already listed on the process, then there is a preferential issue which can go to the QIPs and other means also. And there are other hybrid instruments also. So while preparing for it, I'll just go through the sequence how it goes. Why we should go for a public? What happens these days, the business, I would say, is spreading globally. It's not limited to the country frontiers. Everyone is aiming to be a global business entity. So obviously, when you plan to go for a globalization or a global, to become a global entity, the first question comes in mind is the resources, the money requirements, because all business requires money, whether you are operating a manufacturing concern or you are operating a e-commerce platform. Everyone has a requirement for funds. Then the question comes up, what is the mechanism to arrange those funds? Directly go to the IPO, or first initially you go with the venture capital funds or the angel funds, then migrate into the private equity and ultimately to the IPO. I mean, these are various channels. Many companies opt for a direct IPO, many passes through these channels. But the purpose, ultimate aim remains the same: to garner money for the company's future plans, for the businesses. In many of the cases, we have seen IPOs, they have been timed and they have been placed with a view to pay off the debts that the company was carrying and partially for the expansion purpose also. So in any case, the purpose may be different, but the ultimate aim is that the money should hit the company's bank account. So these are the various the purposes for which an organization can plan for IPO for a growing company. They are seeking opportunities for growth and capital requirements for organic or inorganic growth. Many times, inorganic growth also plays a very dominant role. If you have to plan for an acquisition, you can always go for raising the money from public. liquidity for shareholders, because what happens is that you might have a private equity or other HNI investors as an investor in your company. Then FPO or OFS is another way by which they can offer their present stake in the market to the shareholders. So this is a general flow chart, how one has to prepare for the IPO and how the CFO. So if one has to ask you what is the role of CFO, I would say IPO cannot happen without a CFO. So from end to end, normally we use the term P to pay, procure to pay. In the same context, if you say role of a CFO in IPO, from starting initiation, the thought process till the final conclusion, and even after post IPO, there are mandatory requirements that one has to fulfill. So you cannot ignore that once the IPO is complete, your role is over. No, post IPO, the role is more critical because you need to convince the investor, you need to reach out to the investors that whatever the promises have been made during the IPO, now we are on the track to fulfill those promises. Many times what happens, we have seen the IPOs, they have been a very grand success. But of late, the performance of companies have not been to that extent which was, I would say, promised to the stakeholders, promised to the investors. That creates a negative sentiment in the market, which closes the doors for the further borrowings or further issues by the company. So normally, as I told, the process starts with the board meeting to approve the issue. It's a formal process. Once the board takes up the matter, but normally, informally, the process starts very early. When you are totally prepared internally, then you go back to your board and say that now we want to go for an IPO. We are prepared more or less. As a next step, then a kick-off meeting is there, which involves appointment of a merchant bankers, then book runners. One has to identify there are other certain requirements, underwriting agreements are there. It's better to finalize them in the initial stages so that at the later stage there are no surprises left. Then there is a research presentation. The research team of the company along with the merchant bankers, they prepare a presentation to be floated in the market. So there are various types of meetings which happens in the market. Normally many of us have heard about the road shows. So that is one of the popular form of the presentations that the companies and the way the company is reaching out to the prospective investors. Roadshow is nothing, a meeting at their location instead of a meeting at the company's location. It's different from the political roadshow that we have seen in the elections. It's not going to the roads to sell your IPO, but it's going to their location to present your case that we are a fit company and you should invest, why you should invest, and what we are promising you, how you are getting benefited by investing our company shares. So that is one of the critical aspects. And the various forms, like there can be road shows happens for the institutional investors, which are largely the insurance companies, which are largely the mutual funds are there. There can be foreign institutional investors also. But largely the major form the investor remains to be the institution, domestic institutions, which happens to the mutual fund industry, and second is the insurance and other companies. Then there are a set of HNI investors also, which one can tap to the market. Then start the process of due diligence. Then you need to appoint a good firm of auditors, which normally is recommended by the merchant bankers also. Or if you are already having a good set of auditors, then you need to recast your financials, and minimum for 3 years you need to recast them if you are going for a normal IPO process. And that is a very key exercise because it's just rewriting the books from the perspective that you are going to the public. There might be many adjustments which you have in the financials you might have reported in the past. You might not hold good for the IPO purposes. So restatement is just a re-preparation of your financials from a deeper side. And it involves many agencies because what happens is that when you file a pre-DRHP with SEBI or you go for a pre-approval for the stock exchange, there are many queries floated by them. And if recasted figures fails any of those queries or there is a deficiency, there might be a possibility the process will be delayed. So the major role comes with recasting of the financials, convincing the auditors to issue a certificate. In turn, it is a base for the valuation also. So while the valuation exercise is carried, it is a combination of your past performance, but largely these days the valuation is based on your future possibilities of the business. We must have seen in past in many of the IPOs, although they have been a grand success, but in post-listing they have collapsed without naming them. So their valuations have been very futuristic. And basis that projections, the merchant bankers, they prepared a certain set of valuations that the company will be performing at this X level in 24, 25, 27. Might be the revenues might double, profits can be can jump by 4x, 5x, 6x. These are kind of futuristic valuations that companies are working out, and they are open because once the merchant bank and the valuer certifies you, I don't think there is a challenge from the regulatory point of view. The challenge comes from the investor's point of view. You need to convince that how you are going to achieve those valuations. Are they real valuations depicting the company's future probabilities of the business, the future targets of the business, the market share? I mean, there are certain many factors are involved. So valuation remains to be a very important aspect, and secondly, valuation is also important because what are the premium you are obtaining. So without diluting much of your equity, without diluting much of your capital base, you will be getting money in form of premiums, which again will going to increase your net worth, and it helps in long term, and your stake or the promoter's stake remains intact. So initially the requirement is that, I mean, there can be a case the company does not get a full subscription. In many of the cases when the promoters have money, they subscribe it to the tune of 90%. But over a period of 3 years from the date of IPO, they need to dilute it and bring down their stake, not more than 75%. So 75% has been kept as a cap for the promoters, but they are given 3 years window. If due to any reasons they have to subscribe more during the IPO, but they can further sell it in the open market once the IPO subscribe is a success. Because failure of IPO is more critical compared to promoter increasing their stake during the time of IPO. If the company performs well, they have a chance to put in an offer for sale, or they can go for a block deal also. There are many other avenues. So while planning, once the valuations are done, then the publication of research report is there. Then I would say a pre-DRHP is filed with the SEBI, how we are going to plan it out. Then the comments are expected, the SEBI issues the comments, they are incorporated, then a revised documents is filed, stock exchanges are approached for in principle approval, allotment of temporary ISIN, post listing they allot a permanent ISIN to the company's securities. Then you need to file a final DRHP with the SEBI, and it goes with the stock exchanges also. And the timeline is T plus 140 days. These are just general timelines. It's not a mandatory one. It depends on the company how quickly they can do. But looking to the case, these are the minimum that one has to maintain. It cannot be a hush-up activity that you can conclude in a week's time, 10 days time. Because while selling your product to the institutional investor, it takes a lot of time. Even months are spent. One investor may take 3 to 4 days because their analysts, their research team are there, and there are multi-level discussions with them. It's not a single person who can take a call. They have an integrated, or I would say centralized research team who scrutinizes your company, who scrutinizes your figures, your presentation. So it takes a little bit of time. However, it is always advisable if the number of institutional investors are lesser, that will be a less painful task and more of a surety that you will get the much required investments. At the same time, you can have the anchor investors also, which can be in any form. Then one has to go with the SEBI for RHP, then RHP is filed with the ROC, then roadshow starts. So official roadshow starts that time, but unofficially, as I told, you can start even before your board meeting also. You can be in informal talks with your prospective investors. Then there you need, one goes for tapping the anchor investors, depend on the size of the issue, depend on the market response from the roadshows. They can go for anchor investors also. The commitments are there for the anchor investors also. And now there is a lock-in period for the anchor investors also. They cannot immediately dilute post-equity. Government has tightened the norms because many times we have seen post-listing, they have been diluting and selling the equity, and the stock prices, they were, just going half of the issued price, and many of the cases just 25-30%. Because they loses their interest once they make their money. Then the issue opens, then there is a separate account opened for the proceeds of IPO. Then the allotment process is started, then the issue closes, and this is the entire process by which the IPO goes. But once the IPO is over, I would say a more responsibility casted on the CFOs and the company's shoulder. Reason being, you need to utilize the proceeds for the purpose which has been defined in your DRHP, the offer statement that we are using the money for this purpose, and deviation from this allowed to the extent that there is no, the timelines is not fixed in which timelines you need to utilize the money, but you cannot utilize the money for any other purposes in the normal course. Going for utilization for the purposes other than mentioned in the offer document is a very lengthy process. Again, a recycle of going to the shareholders, again going to the SEBI note, which is again I would say a re-exercise of the IPO exercise. So it's always advisable before planning the ultimate utilization of the money, the proceeds of the IPO, one should take care that ultimately what is the aim for which we are raising the money, how the company is going to utilize. There can be delay in the execution of projects if it's for the setting up the manufacturing plants in the case of manufacturing company, or in the case of infra companies can be setting up the projects. So delay is allowed, but diversion of fund for any other purpose is not allowed in the ordinary course. So that is a very, very difficult and a challenging task. And then every quarter you need to file a certificate certified by the state auditors. What is the utilization, how much amount is remaining in the same bank account. You can short-term park in FDRs, but you cannot withdraw that amount. It continues and you can always withdraw against the utilization certificate from nowadays it is mandatory from the auditor's side. And post that, then the compliance requirement comes up. Every quarter you need to file your accounts within a period of 45 days from the close of the quarter. Half-yearly the balance sheet has also to be attached, and if you have debt, then there has to be some debt parameters are also required. Interest service coverage ratio, debt service coverage ratio, all those requirements are there. Quarterly, every quarter one has to hold the board meetings. You need to have a set of independent directors on the board. So more of a transparency, more of a governance angle comes up. So purpose was that the role of CFO is never diluted, that if someone says that I have done an IPO, money has hit my bank accounts, I am free, no free. More of a responsibility, the legal responsibility comes over the shoulders. And one has to be very vigilant and that the money should be used without any undue pressure to please anyone that I can divert this money by this mechanism or that mechanism. So that is the responsibility casted upon the CFO. This is again a timeline how it goes up. It's a cycle. More or less it remains the same. If someone is planning to go for an IPO, the exercise remains the same. So if you genuinely ask me to face an IPO, I would say it's a dream of everyone. I mean, a company going to IPO is a dream for the company. The team of the company which is handling the IPO is a dream to them also, because these days there is a lot of buzz in the market. Anyone with the IPO experience is more preferred compared to a person who has not handled the IPO. So at the same time, company also gets a leverage. It can proudly say, yeah, I am listed on such and such stock exchanges, I am a public listed company, a widely held company compared to unlisted entity. We have seen the cases also where the companies have borrowed from the market, their purposes have been solved, and then at a future point of time they come with a delisting offer also to the shareholders. So delisting is also there. But again, they have already touched upon the taste of IPO. So for them, the delisting is a normal phenomenon. Might be after 3-4 years in form of other entity, they might again hit the capital market once they have raised the money. So this is how the time cycle and the flow chart of IPO works here. And as I said, from my past experience of handling these issues or reaching out to the investors is very critical because what happens is that even once the IPO is over, you are the front person with whom the investors will be contacting. The promoters or the company management, they are the secondary persons to whom they will be reaching out. But you are the front line. This was the promises that you have made. You are a finance person, you understand more. And how you are going to attend the investor meetings. Normally, many of the research agencies, they are holding up these investor meetings twice a year, thrice a year. And most of the companies, they are participating in it. So from the company, you are the face of the company. As a CFO, it's the face of the company, because whenever the promoter goes to the meeting, he talks from the broad business side that I want my company to be 1 billion or 2 billion. But it does not have a timelines. But what happens is that the investor expects a timelines from him. If it has been said that we have a target to 1 billion or 2 billion, they will obviously ask you, what is your plan? How you are going to reach 1 billion? Then you have to be very ready with I would say, convincing answers to them. So the role, I would say, of a CFO is more responsible compared to company's management or the company's promoter. He always remains to be the front face of the company with the existing investor or the potential investors. Keeping them in good humor, in good terms is also important, because the requirement of the funds never ends for a business who has a desire to grow. So always you need to be very, very firm on your stand, firm on the commitments. It's not that 100% you need to match. It has to be, from my experience, it can be a range bound. You are not required to say that pinpoint I will 11 rupees I'll earn or I'll have 1 billion, you can just give a range that this is the market scenario. We work on this parameters, we work on this matrix, this is the global scenario. We might get affected from it, but in a normal course, we can achieve these much of the targets. So that gives them, I would say, a comfort that yes, whatever you are delivering to them or whatever you are explaining to them, you are going to make them happy. So what happens in the future for further borrowings, it becomes very easy for you to tap those investors also, and you have goodwill in the market. Remember my words, once you are in the market, it's very important the organization and the group or the company, I would say, enjoys a good reputation in the market in front of the investors. If the reputation is not to that level, despite your business size, despite the money you are earning, you won't find a good set of investors in the market. So that is a very key thing. So whenever we present, whatever we submit to the outside world, we should be sure that we are not just, I would say, extrapolating the figures beyond a certain level. We can take assumptions. The assumptions should be clearly specified. These are the assumptions. There can be case scenarios, 2 or 3, like normally if you take my example, when I joined this organization, we were something at around 1700 crores of turnover. This year we closed about 3600 crores. And we have done a capex of close to 900 crores, with increasing merely a debt of 300 crores. And now we are looking for another round of, I would say, QIPs or maybe another. So it remains but we also face the same turmoil because we are in auto industry post-COVID, and those times are very turmoil times. So when first I reached out to the investor, the reaction was that, yeah, you guys only guarantee commit, but you never deliver. Your deliverance has been very poor. Why we should be interested to even retain our holding? Why can't we appoint a board, a director in your company when we owns about 10% of the joint equity as an institute? They have a right to appoint about 11%. So over a period of 2 years now, they are the persons who are calling to me, yes, the performance is superb, whatever has been committed, and now what is your plan for the next series of funding, because you have debt in the books, you want to clear that debt, or what is your expansion plan? So one has to be very, I would say, very interactive with the investors, and they can call anytime. There is no timings for them that they cannot call you in early morning, they cannot call you in late night. Can call you anytime, you have to respond them in a very nice manner. But yes, as I told, the reputation is something which is very important. Of the time they call you, 80 to 90% they will be going to call you only, not the promoters. Remember this. So these are the, I would say, major key points that one has to keep in mind as a CFO. From pre-plan stage to the final conclusion of IPO, it's a ongoing exercise, I would say. Raising the funds, diluting the funds, sometimes you might go for a delisting also. That time also, you need to have your investors in a good humor so that they approve the scheme of delisting. In many of the cases, we have seen that the delisting exercises have been rejected by the shareholders. So avoid those situations. And these days, there are institutional advisory firms, independent, which have been licensed by SEBI. So in your annual general meetings on various resolutions, they are issuing advisories, which the institutions are following to the extent of more than 99%. If they have voted or they have advised as a negative vote for certain of the resolutions, especially from the promoter side, definitely those resolutions are going to be defeated in your meetings, because promoters being interested party, they cannot participate. You are left with the mercy of the institutional investors, and there is a very clear cut. You can have a good terms with the institutional investor, but the simple answer to the voting comes if out of the 2 firms, even one has given a favor, we can go for a favorable voting, but if both has given a negative, it will be a negative voting, irrespective of our terms. So it's not only institutional investors, you need to have in touch with the institutional advisory firms also, and that is possible when you enjoy a good reputation, good connect with the market, and you are delivering your promises.